Hello, everyone. It's Larry Kotlikoff. I'm delighted to be back with you on Economics Matters, the podcast. I'm going to show you uh, something pretty cool today. It's called Upside Investing. It's part of my company's MaxiFi Planner software program, and it's one of the reports that you can run. It's a way to help you invest, do what seems impossible, which is to invest in risky assets, in this case, the stock market, but also make sure you have a living standard floor that can only go up through time. And the trick here is really simple, but the actual execution requires the software. So it's not something that you can necessarily do without the software correctly, because there's lots of interconnected parts. But the basic idea is this: there is a safe asset out there, which is the inflation index bonds that the federal government markets to us. They're called TIPS, Treasury Inflation Protected Securities. So we can take our money at some point, and we could potentially put it all in TIPS. And when I say that, I mean a ladder of TIPS, a set of different TIPS that come due through time. And there's still some risks because the TIPS don't come in the form, the payout is not a constant stream of inflation adjusted income. It's if you buy let's say a 10-year tip, you get a coupon payment that's adjusted for inflation. And then after 10 years, you get your principal back. So the stream is not smooth. In addition, if there's a lot of inflation, you have to, or even a small amount of inflation, you have to pay taxes right away on the adjustment to the coupon payment that occurs due to inflation. I mean, that's the good side is that they do adjust upward your coupon payment as well as your principal, but as they adjust your coupon payment up for inflation, you have to pay taxes on it if your money right away, if your money is, if your tips are being held outside of retirement accounts. If they're inside an IRA or 401k that allows you to invest in individual securities, then you don't have to pay taxes on that phantom income, on that inflation adjustment until you actually sell the tips. Well, not just sell the tips, but uh, sell the tips and then take the money out of your retirement account. But anyway, so the idea is a strategy here. Upside investing is a combination of an investment strategy. You're investing in tips, but you're also investing in stocks. But the key thing is that you're not just taking on a strategy about investing, but also about spending. You don't spend it all out of your risky stocks until they've been converted to, until they've been sold off down the road, and the proceeds have been used to buy more tips. So at that point, you can raise your living standard floor. And that's what I'm going to show you, which is uh, a living standard. I'm going to have an example here where you run the program, you run Upside Investing, you tell the program how much you want to invest of your assets in stock and how much the rest will be invested in what we assume will be tips or some other safe asset yielding about a 2% safe return, for sure return. And then we'll see, hey, here's a living standard floor if the stocks go completely down the tubes. So you put the money in stocks, 20% of your assets, they're completely lost. The market completely crashes 100%. And that's the worst case scenario, obviously. But since you're not spending out of those stocks until they've been converted into safe assets, into tips down the road, your living standard floor is protected by your tips. So that's your strategy here. Spend only out of safe assets. Treat your stocks as lost until they're found. And then I'll show you that we run Monte Carlo simulations that entail looking at different trajectories of how well your stocks will do. And then at some point, you'll start converting, and you'll specify this in the program, when you're going to start converting your stocks and when you'll stop, maybe at 60, between 65 and 75 or 65 and 80, you'll start gradually converting your stock. So if it's, let's say, between 65 and 75, the program will know when you're 65 to take a tenth of the stocks that you have, whatever their value is based on the Monte Carlo simulation, and convert those to tips. And we'll assume you can convert at the same return so that the tips in the future will be yielding the same return as today. That's an if, and so there's some riskiness associated with the rate at which you'll be able to reinvest into tips. So I don't want to suggest that this is a perfectly safe uh, scenario in that respect, but uh, the anyway, the assumption is that you'll take a tenth out when you're 65 of your stocks, whatever they're worth, a ninth out when you're 66, and an eighth out when you're 67, and by 75, you'll have completely left the market, and you'll be just in tips. And each time you take money out along each trajectory, your living standard floor is higher. You'll see this in a second. So let me just share my screen here, and you can see for yourself how this works. So I will get rid of some of this, these things, and now we're just going to go to the program, and I'm going to look at a case that I've set up, and it's a person named Joan, and Joan currently is, hope everybody can see this well. I'm going to so I can expand this a bit. Joan is 64, and so she was born in 1959. Her maximum age of life is 100, and we always plan for people to live to the maximum age of life because they might. You can't count on dying on time, so that's the assumption that economists make. Your planning horizon has to include the financially catastrophic event, which is that you live to your maximum age of life. She's currently working and is going to retire this year at age 64 on her birthday. And well, no, she'll work through this year, and then next year she'll be retired. That's the way this is set up because she's currently 64. Okay, and then what about her earnings? Well, she's making 40,000. But in the past she's made more money. This is her Social Security earnings record. She's working a little bit more like part-time this year and for the rest of this year. And the other story about her retirement accounts is that and other assets is that she has about 2.5 million in retirement accounts and an IRA. She has 150,000 in her checking account. She has a house. She lives in Massachusetts. It's paid off. There's no mortgage, but she has significant annual expenses for housing. So let's just run her base report. She has no kids, and under these settings and assumptions, we're assuming that she's going to earn 2% real. The inflation rate's 2.25, and the nominal rate of return on regular assets and retirement accounts in the base plan is 4.5%, 4.25%. So this means she's going to get about a 2% real return. It's not exactly 2.2%, it's 1.96. And if you look at what the current tips yield is, if you go to zvbodhi.com, Zvi is a former colleague at BU, terrific economist, and you can see that the yield today on inflation index bonds, 5-year inflation index bonds are yielding 2.1%, 30-year bonds tips are yielding 2.2%. So 2% is a slightly conservative assumption given today's market. Anyway, let's just uh, look at her reports that she can run. These are deterministic reports, assuming that she puts everything in tips or some other safe asset yielding 2%. And I'm going to run her base plan, and then we can maximize it. But she's already going to do the right thing by Social Security in her case, which is to wait till 70. That's already set up in the base plan. So I'm not going to bother maximizing her base plan. It's already pretty well maximized. And she's going to take her retirement account money at 67 when she reaches full retirement age. So the actually at 65 when she retires, so she has enough liquidity to wait till 70 to take her Social Security. So let's just run the base plan here and see what it shows. Well, it shows that she has about 4.5 in lifetime resources and about 2.2 million of that, 4.5 million of is the resources. 2.2 she's spending on a combination of housing and taxes and Medicare Part B premiums. And then she's got discretionary spending of about 2.3. So let's look at in detail at her uh, lifetime balance sheet. Her discretionary spending is down here, 2.2. Her uh, lifetime earnings that's left is just about 40K, and then the Social Security benefits uh, in present value about 900,000. She has these retirement assets. We're kind of valuing these at the end of the year. In the end of year prices, there's a, as I said, 2.25% inflation rate. And then she's got this house worth 850,000. And the the housing expenses that she is experienced, why is that number so big? Well, it has three components. She's got annual expense, well, she's got the annual expenses that are high, and then if you total them up and present value them, it's $510,000. She's going to leave the house uh, unsold to her grown children, and that is what people might call trapped equity, but it's also called an equity bequest. We don't want to give it a pejorative name in our software because you're giving something to someone else, so it's not necessarily a bad thing. It's not necessarily something that you don't want to do. But then the holding costs here refer to the fact that she's got this $850,000 house. She could be earning 2% on it. So implicitly, she's paying rent to herself by not selling the house and investing the proceeds. She could safely be earning 2%. So that's what economists call a holding cost. So altogether, that's a 1.3 present value, $1 million present value expenditure. And then there's taxes, federal taxes, FICA taxes, state income taxes, since she lives in Massachusetts, and then Medicare Part B premiums. So this leaves her with 2.3 million in discretionary spending power, and the uh, uh, let me just show you her spending annually. It looks like this. This is discretionary spending she gets to do every year in today's dollars is close to 90,000, 87.6 thousand, and then there's housing expenses every year uh, and taxes. So we have this uh, these different components that are showing up, and the right, and this isn't leaving. This is not including the spending on or the fact that she's leaving out this leaves out the fact that she's leaving the house to her kids, and that's what might be called trapped equity. So that's why, in terms of the lifetime spending uh, on fixed on non-discretionary elements, there's a big component here which is not included in the annual spending outlays. It's not an annual outlay. So anyway, that's basically, the story. You can kind of drill down, look at taxes. You can look at uh, the spending each year that she'll be doing. You can look at, if you want to look at the details about uh, taxes and drill down, go to this year at a glance report, and you can choose any year you want, and you get to see the whole tax report, base tax, taxable income, adjusted gross income, the different components. So you can keep drilling down to see what's causing the taxes. This is basically a kind of like a turbo calculating your taxes like TurboTax would do, but doing it for every year in the future, no matter what year you choose. And it's all in today's dollars. So it all makes, you know, it's all verifiable in the sense that every number in this report, these sets of reports can be tracked back to either your inputs or to tax calculations that you can verify by looking at the details. So anyway, now what I'm going to do is go back to the reports. There's a base plan and a maximized plan. These, again, are deterministic plans, so they're based on assuming you're going to get for sure this 2% real return. And that's taking the uncertainty. You might be investing in stocks, but in terms of the certainty equivalent, economists have this way of dealing with uncertainty, which is we try and translate the uncertainty into something that's for sure, and you can get for sure a 2% safe return. So this is what's called certainty equivalent planning. It's taking something that's uncertain and making it certain by using conservative assumptions about your future earnings, your future rate of return on your investments, and your future special expenses. All these things should be entered very conservatively when you're doing deterministic planning. But then there's this upside investing, and full risk investing. Both are what we call stochastic planning, because they're not saying you're going to get for sure, let's just be conservative and assume you're going to get for sure a 2% return, but they're saying let's actually track what you're going to experience based on what returns you'll actually draw in the marketplace. So I'm going to tell you about upside investing today. I'm going to do another webinar, a podcast in the near future that deals with full risk investing. And with upside investing, you're not spending out of anything that's risky. That's what I mentioned before. You're investing either in stocks or in tips, but the stocks you're treating as lost until they're found. In the full risk investing, you're treating the stocks as uh, as something you can spend out of, even though you're not sure how well they're going to do. And under full risk investing, you spend out of all your assets, the risky assets as well as the safe assets, but you do so in a conservative manner, as I'll describe in a future podcast. But let's just take a look at the upside investing. And so Joan here has 150K in a checking account, as I kind of indicated. That's her regular assets, and she doesn't want to invest any of those in stocks. She's just going to keep that in cash. And then if we just hit continue, we see that her retirement account's 2.5 million. She's going to put she's decided to try and put 20% in stocks, and that's of course $500,000 that she's going to put in stocks. But she's going to let those stocks ride, and in 2034 she's going to start converting them into tips, and in 2044 she will have finished all these conversions. So So the conversions will be a tenth in 2034 of whatever stock assets she has, a ninth the next year, et cetera, and an eighth the following year. And so we're going to run 500 trajectories in this Monte Carlo simulation. I'm going to show you the results. This particular report takes a little bit longer than a half a second, which is what our basic report takes to run. That's the deterministic report, our basic plan. But here we have 500 trajectories being run. And under each trajectory, there's 10 years of accumulating and then another 10 years of selling off your stocks, depending on how big they, whatever their value is, and investing them into tips. And then you're able to have a higher living standard floor because you're going to be spending on a sustainable basis out of all the tips you have. And so here we see what happens if all those stocks that you invested in went to hell. You lost every penny. Here would be your living standard floor based on the 80% of your retirement account assets that you did not lose that you invested in tips. Joan would get to spend about $76,000 a year in today's dollars. And by the way, this method of upside investing for the 10 years that Joan is letting her stocks just ride, there's no what's called sequence of return risk. She's not taking money out when the market does poorly, and then the next year, because she's taken money out, or not because, but just accidentally, the market does quite well. But because she took money out this year, she has less money to do well in the market, left in the market. That's what's called sequence of return risk. Depending on what particular sequence of return, how you do your withdrawals, you can get, you're subject to additional risk from associated with your withdrawals, but there's no withdrawals happening here for the first 10 years. But let's go down here. So that's her living standard floor discretionary spending per person. Since she's a single person, the discretionary spending itself is also the same value, 75,646. And then over here, we see these living standard trajectories that she might experience. And these are trajectories of her living standard floor. So take a peek here. You can see that this is the base floor, the green and then the red. If everything's lost in the stock market, she just stays at that basic living standard floor. But over the next 10 years, over the 10-year period between when she is, well, let's see, she's now 64. So when she's 74, between 74 and 84, she gradually sells off her stocks and buys tips. And if she does quite well, that's the green trajectory. Every year, you can see that she's raising her living standard floor. And then at this point, she has converted all her stocks to tips, and then she's at a permanently higher living standard floor that's constant. So this is doing exactly what you would expect to see. Let me just tell you about the green trajectory. We've run 500 trajectories here of exactly the same behavior, and the green one is the one that had, on average, the 95th highest average living standard. Okay, so the living standard for all these trajectories is down here, and then they differ once you start the withdrawals. So you can take the living standard every year between Joan's current age 64 and when she's 100, take those values and just average them, and that gives you a number, okay? And in effect, a ranking. That's the average living standard on that trajectory. So we rank all these 500 trajectories based on their average uh, living standard across all the remaining years of life. And this green one has the 95th highest average. And this black one has the fifth highest average. Now, even the fifth highest average uh, produces basically, once all the conversions are done, uh, um, Joan here is living at a 90, based on a $95,000 uh, uh, living standard floor. So her floor goes up from 75,000 to 95,000. So even just investing 20% of her retirement accounts in the stock market, and here we're talking about the S&P 500 index fund. That's our default stock market investment, and we're taking draws from its historic returns going back. The series of returns that we're taking draws from go back to 1925. So we have basically 100 years of experience in the stock market from which we're drawing returns. We're uh, obviously starting next year, we'll have, it'll be 2025. That'll be exactly 100 years of stock market return history. But the point I'm trying to make here is that you can have a lot of upside without putting a lot into the stock market, because Joan's only putting 20% in there. And look at the 95th percentile. Uh, uh, if she really does well on the market, her living standard, um, her discretionary spending each year is not at the original floor, which is 75,646, but it's up at 227,877. So that's plenty of upside risk for Joan. She's quite happy with that being her upside. She can check what she's currently spending, and uh, let's suppose that Joan checks and that she's spending maybe $65,000 a year on discretionary expenditures. Well, so having a floor of 75,000 is a conservative floor. And in addition, she's got all this upside that she likes for herself and for leaving funds to her kids if she passes away, because she's not likely to make it to 100. And then in addition, she's in good shape because if she needs to move into a nursing home, God forbid, she has a $850,000 house she can sell. So this whole thing is really a great plan for sleeping at night, for not worrying about how well that your assets do. You've got your floor protected, and having a living standard floor is really the holy grail of financial planning. Financial planners have been talking about bucketing strategies and trying to secure your income. But to economists, what we're really interested in here is not securing your income, but securing your living standard. And this is exactly uh, what we've got going on here, a living standard floor that can only get better. So this is like investing in the stock market with no risk. I don't want to say that exactly that way, because she's putting 20% of her assets, $500,000, in the stock market. The stock market could always go to zero, and we're considering that case here, but that's extremely unlikely unless we have like uh, that's the worst case scenario in history in terms of the stock market's uh, performance was between 1929 and 1933. This was during the Great Depression. The stock market lost, in nominal terms, 86% of its value, but prices fell dramatically during this period. We actually had significant deflation. So in real terms, the worst return was probably like negative 65%. I can double check. I should know that number, but I don't. But in any case, even during the Great Depression, over that period, um, people, if they cashed out 4 years after the stock market crashed in uh, uh, in 1929, they would still have 35% in real terms of what they had in the market to begin with. But of course, the market did rebound. It took many years for it to come back. It didn't really get back to its uh, value, even its nominal value, until the 50s. So stocks can do poorly and stay and do poorly for a very long time. So it is a very risky investment. The U.S. stock market has averaged in the post-war period about 9.5% real, maybe a little bit lower than that over the entire 100-year, almost, well, 99-year history up till now. But anyway, here you get to see information about the upside trajectories, and of course, if you just want to look at uh, the floor to Joan's living standard and what things are like if she were just living at the floor, the original floor, and the market went entirely away, you can see all the information about spending details, all the tax details about the original living standard floor. So once again, just to remind you, we have deterministic planning, we have stochastic planning. Upside investing is about uh, really what I think the middle class and upper middle class people uh, should want to be doing, which is securing their living standard floor and only experiencing upside risk. And the only way you can do that is not to spend out of something risky, because that, you can't assume for sure that something that's risky will be there in the future. Uh, and when we do the podcast, when I do that uh, in a in the very near term, I'll give you a podcast on that and show you the full risk investing for Joan, that scenario. There's upside and downside. You know what I'll do? I'll just take a look and run that case, and uh, this has got Joan considering three different portfolios: 50/50 stocks and bonds, 20/80, and 80/20. I'm going to just show you this really quickly, but then I'll still do a podcast that uh, that uh, gives you more information about this particular way of looking at your investments. And these reports, this particular full risk investing report I ran uh, before I started this podcast, so we don't have to wait to see the results. I'm going to show you the results. If uh, if Joan invests in uh, her base, her current strategy, which is 50/50 stocks and bonds, that's the red curve, and she does very poorly. You can see that even investing in a kind of conservative 50/50 portfolio uh, still produces trajectories because she's spending uh, in a conservative manner out of those stocks, half of which are, sorry, retirement accounts, half of which are invested uh, in stock, and the stocks do very poorly in this scenario. In this, I clicked on very poorly. Well, you can see that there's lots of trajectories here, that lots of outcomes here, years in which her living standard is below her her base plan, where she would just invest in stocks, and that's the height of the gray bars. And then if she invests I'm sorry, I'm looking at the risky strategy. That's the red curve. Uh, that does particularly poorly in many years. But even under uh, her current strategy, which is the green curve, there are years in which she doesn't get to spend as much as under the base plan. And that's true even under her safe strategy, because she's spending out of risk, something that's not particularly safe. And then if she does really well, then you see these trajectories um, uh, and I'll talk more about exactly what they're telling us, these trajectories. They're all above the gray bars, and she's uh, under under the any way she invests her money, whether it's 50-50, 80-20, 20-80, those are the three options. Her annual discretionary spending is, even though it's not particularly, it's not smooth because she's always adjusting her spending up and down based on how well she does on the market. This is very unlike traditional conventional planning, which says just put your spending and retirement on autopilot. Well, that's not what economics says to do, because you don't want to, not take into account the reality that you just lost a lot of money on the market. You've got to cut your spending. That's what economics says, so that your living standard is adjusting immediately. Otherwise, you're going to, if it keeps, even if it doesn't, let's say it doesn't do well or poorly in the future, well, if you don't adjust now, you'll have to adjust later to the fact that you just had this big hit. So the whole idea is to smooth your living standard, which is to adjust uh, all the time so that you're not facing an even lower living standard down the road. Anyway, that's it for today's podcast. Just to repeat, if we want to look at upside investing, and you want to have a living standard floor and just upside risk to your living standard, that's this is for you. And the reason that it's important to run MaxiFi uh, to uh, to accomplish this upside investing is that you get to see how much the floor is impacted by the how much you put in stocks. If we have Joan put more in stocks, then that means she'll have a bigger upside but a lower floor. If we have her put less in stocks, she'll have a higher floor but a lower upside. But you can see that the stock market's power to produce an upside, if you don't kind of start withdrawing from it in bad times, if you just let it ride, is very significant and can produce very high upside, even in the fifth percentile case. So, um, so I hope you got the gist of this. It's a combination of spending strategy and an investing strategy. It's understanding that if you put more in stocks, where's the trade-off between your living center floor and your upside? You can play around with this all day long in the program and change different amounts that you want to, percentages of your assets that you want to put into stocks, and even make additional contributions to stocks. The program lets you do that through time. And this is quite unique, but the key thing, reason for running this is not just seeing the trade-off, but also understanding what it is you're supposed to spend. So as you go along, first of all, right now, if you're, Joan at age 64, she gets to learn, here's how much I get to spend, and here's how much I need to not spend of my resources, and invest in tips. And uh, she would be presumably buying a ladder of tips. And we've talked in other podcasts about building a tips ladder. Uh, and and then she gets to see what her taxes will be, all the information about achieving this plan. And then as she continues running MaxiFi through every year, if not every couple months, based on anything that might have changed, uh, she'll get to see, as for example, if she's along this maybe uh, dark 75th percentile, this one that I'm kind of going along right now, uh, if that turned out to be how things worked, she would figure out, as she's using the program every year, how much to spend that year, and uh, what the you know, what to not spend, therefore, how much to put into, how much to convert from her safe assets into, sorry, from her stocks into tips, and then look at things again a year later. So this is really trajectories that are showing what happens if you keep using MaxiFi every year through time. So anyway, let me bring this to a close. I want to thank you for joining me today. I want to thank you for using MaxiFi Planner. I want to thank you for telling all your friends and colleagues about the program, your employer, so they can buy a license to provide the software as a fringe benefit uh, to they can license this for their entire company. Boston University, for example, does that for all its employees as a fringe, provides it as a fringe benefit. I want to thank you for buying licenses to MaxiFi for all your children and your favorite niece and nephew and your brother and sister, or any of your relatives, because this is a tool that can help people safely produce a higher living standard, but also stay safe in terms of their living standard through time. So anyway, thanks very much. Talk to you again very soon.